Welcome to Shooting It Straight with Stan. I'm your host, Stan, the Annuity Man, America's annuity agent, licensed in all 50 states. Today's topic is comparing fixed index annuity income riders to deferred income annuities, DIAs. And we get this a lot from a questioning standpoint. Which one's better? As I always say with annuities in general, I don't care what type you're talking about, each and every one has its benefit and limitation, good and bad. So let's go over that. Let's start with the deferred income annuity first. A deferred income annuity is nothing more than an immediate annuity, a single premium immediate annuity that you defer past 1 year. So with a single premium immediate annuity, the grandfather of all annuities in the developed in the Roman times, that's where the word annuity comes from. Annua means payment in Latin. Deferred income annuities is when you ask the two questions: what do you want the money to contractually do? When do you want those contractual guarantees to start? Anything past a year, an immediate annuity magically turns into a deferred income annuity. Now, the positive about the deferred income annuity, there's no moving parts, there's no annual fees, there's no market attachment. It is a straight transfer of risk product for lifetime income. You can use it inside of a IRA. It can either be a DIA or a QLAC, which is a deferred income annuity that you use inside of an IRA. I've done videos on that. We'll go down that rabbit hole. But a deferred income annuity can be used in Roth IRAs, non-IRAs, IRAs, etc. So it doesn't matter which one. The income coming and derived from the deferred income annuity is going to be taxed based upon what type of account you have it in. But let's look at it from a contractual guarantee standpoint. It is a stripped down transfer risk pension product. You can structure it your life, joint life. You can structure it just a period certain or a combination. You could do life with an installment refund, or life with cash refund, life with period certain, or joint life, all of those above. There's 40 plus ways to structure it. If you go to my site at theannuityman.com, you can run DIA quotes all day long. We have the best DIA calculator on the planet, quoting all carriers. It is a rigid contract. So when you buy a deferred income annuity, you have ripped the knob off the water faucet. You own it. So in other words, if we ask the question, what do you want the money to contractually do, and when do you want those contractual guarantees to start? And you say, I need to start past 1 year. We're going to quote deferred income annuities. Okay. Now, in a non-IRA standpoint, the income has what's called an exclusion ratio. It's a combination of return of principal plus interest. So if you're getting back your principal, you're not paying taxes on it in a non-qualified account. In an IRA account, it's all taxable. But getting back to the liquidity part and ripping the knob off the faucet, let's just say you wanted the income to start in 5 years. You can't get your money back. There's not, well, I don't want to do that anymore. Send me my money. You're going to get it, but it's going to be in payment form. But again, there's 40 ways to structure it: life only, life with period certain, life with installment refund, life with cash refund. We will explain all of that to you. I've written a deferred income annuity owner's manual you can get for free. We've done tons of videos on it. But just think of this: it's an efficient, no cost, no fee transfer of risk pension that you can defer 1 year out to 40 years. Now you say, wait a minute, Stan, why would you do 40? Like for my daughters who are in their 20s, they have deferred income annuities that I've purchased for them that start way in the future because I'm not sure Social Security will be there for them. Plus, I want them to have a pension. And even if they like me or don't like me, that money's going to hit every month, and they can just cuss me out as the money's hitting their bank account. So deferred income annuity, it's a great product. The other thing you need to know about it is the big boys play there. The big carriers, I'm not going to name the names, but you know who they are, the AA plus, they offer deferred income annuities. So if quality is what you really want, if you really want the top tier type A double plus carriers, deferred income annuities where you're going to land. Okay, so that's deferred income annuities. Let's talk about income riders attached to index annuities. So income riders ride on top of the policy. You don't have to put it on an index annuity, but at the time of application, you can choose to attach a income rider for future income needs. Now, currently at the time of this taping, that's the only way, pretty much 99% of the time, that we're using indexed annuities. We're using it as a cost-effective and efficient delivery system for that income rider guarantee. The income rider is a separate ledger. It's monopoly money, but in other words, you can't cash it in or transfer it, but you can use it to determine your lifetime income stream. So that's a good thing. It's a flexible contract, meaning that you could get to the end of the surrender charge time period and you can say, send me all the money back from the accumulation value, the index value, not the rider value. So you can pivot. It's a pivot product. Also, too, with indexed annuities, most, not all, allow a 10% free withdrawal of your money on an annual basis. But understand, if you do that, then you're going to disrupt the contractual guarantees of the income rider. You just can't take 10% out of the accumulation value and not disrupt the income rider. So I know that's being said out there occasionally. I just think that's agents that really don't know what they're doing. But if you take money out, it's going to affect the income rider guarantee, but it does have liquidity. So let's do kind of a side by side. Also, too, one last thing. The income rider that's attached to the index annuity has a fee for the life of the policy. And typically, it depends. There's so many different ones out there. It can range from, say, 0.75% up to 1.5%, 2%. And that's something that you need to look at, and we will help you with during your due diligence process. So let's look at the fees on it. Okay. So indexed annuity with an income rider has a fee for the life of the policy. That fee is not taken out of the income side. It's taken out of the accumulation value side. Okay. I know I'm throwing a lot at you. You might want to listen to it a couple times. The deferred income annuity has no fees, period, end of story. From a flexibility standpoint, the indexed annuity, the income rider, is flexible. Couple flexibility points. You can take out typically 10% annually with most indexed annuity, not all. But it's going to disrupt the income rider because you're taking money out of the policy. The deferred income annuity, no liquidity, none. Okay, you've ripped the knob off the water faucet, period. From the standpoint of a taxation, I don't do taxes on because I'm not a CFP or a tax lawyer, but just basic 30,000-foot view. With a deferred income annuity in a non-IRA account, there's going to be some tax preferential treatment of that income because remember, it's return of principal plus interest. So you're only paying the interest portion. When you run the quotes on my site with Diaz, you'll see that if you put in non-qualified with the income riders last in, first out. Okay. So I'm not sure that's a reason to buy Diaz, et cetera, but it is for some people it is, but I think that when comparing, you got to compare. You need to quote both. We'll quote both for you if you engage us and set up a time at theannuityman.com. Not one's better than the other. The first filter, I think, should be which one provides the highest contractual guarantee number, period. Well, I mean, that's where we are with all of this. You own an annuity for what it will do, not what it might do. When you look at contractual guarantees of the policy, you've commoditized the product. You shop all carriers for that. Okay, so that's the first thing. Second thing, claims paying ability of the carrier. Okay, for lifetime income, I have a rule. My team follows it. A+ or better for lifetime income. Okay, so it's got to be rated A+ or better for lifetime income. And so could there be exceptions? Maybe, but they better run it by me. Okay. But A+ or better, you don't need a sweater. How about that? So that's the first two things that you look at. And then I think the third thing is the flexibility. Do you need potential flexibility of that money? Some people don't. Some people want to go with those blue blood companies with that offer the deferred income annuities. And I think the fourth thing to consider are fees. I don't think fees should play into it. Number one, deferred income annuities don't have fees. And number two, the fees coming from the income rider are taken out of the accumulation value so it doesn't disrupt the guarantee of the income rider payment. Okay, so let's go over that again. And when you're comparing them, you can do it yourself. You can engage us and set an appointment, or you can run the quotes yourself. Run income rider quotes, run deferred income annuity quotes. First filter, who provides the highest contractual guarantee? Not the potential, hypothetical, theoretical. We don't do any of that. It's who provides the highest contractual guarantee. Who's got the, A+ or better. You got to look at the ratings. Then you look at flexibility, whether you need it or not, or potentially need it or not. Okay. Those are the three. And then fees, I don't think should even play in it, but those are the four things. And then I would, read the income rider book. I would read the Deferred Income Annuity Owner's Manual book that I have up there. I would pull up the videos that are specific on those two products that I've done. I'd have a conversation with us and my team. They're not high pressure. You're going to make your decision on your terms and your time frame. But in essence, what you're putting in is part of your income floor that's going to combine with Social Security and a pension if you're so fortunate, or whatever income producing items are hitting that bank account every single month. And there might be, it's not an and or, it's a and maybe this other. You could do one or the other. You could do, you want half in a DA and half in a in an income rider and hedge your bet. But a lot of it comes down to who provides the highest contractual guarantee, and if it's A plus or better. And if it's a substantial difference, there's no need to split it, period. Remember, they're contractual guarantees. You own them for what they will do, not what they might do. Once again, I encourage you to dig deep. Go to our site. I have the books, Deferred Income Annuity Owner's Manual, Income Rider Owner's Manual. You can do DIA calculators till the cows come home, as they say in the South. You can do income rider calculators till the cows come home. We provide all of that for free under no obligation. No one's going to call or show up at your doorstep. And then you can engage with us and set an appointment. We would love to have you as a client, but take your time. Don't fall for sales pitches. These are contractually guaranteed commodity products. There's not one that's better than the other. And if you use those 4 filters, you're going to make a good decision. Hope that helped. I think it did. Try to break it down simply like I do. And that's Shooting It Straight with Stan. My name is Stan, the Annuity Man. I'll see you next time.